Welcome to this explainer. We're diving straight into Nobel laureate Robert J. Shiller's groundbreaking research to unpack exactly how human psychology, rather than cold, hard math, actually drives our financial markets. We love to think of global finance as this perfectly rational, efficient machine, right? But the reality is far more human and, honestly, far more fascinating. To really wrap our heads around this phenomenon, we have to jump back to a very specific moment in time. Picture a black-tie dinner in Washington, D.C., December 5th, 1996. Alan Greenspan, the chair of the Federal Reserve Board at the time, was giving this fairly staid, unremarkable televised speech. But then he uttered just two words: irrational exuberance. And those two words instantly proved the sheer fragility of global finance. Think about that for a second. Just the mere suggestion from a central banker that investors might be acting irrationally caused international markets to plummet, literally overnight. The very next morning, we saw sharp drops all around the globe. Germany's market dropped 4%, Japan's fell 3.2%, and Hong Kong went down almost 3%. It was a dramatic, almost absurd reaction to a simple phrase, but it perfectly shows us the unbelievable power of market psychology over actual economic fundamentals. Here is the crucial takeaway. A speculative bubble isn't some deliberate scheme cooked up by a mastermind, not at all. It is a naturally occurring psychological contagion that infects everyday people. It's a setup where news of price increases sparks an intense enthusiasm that just spreads from person to person like wildfire. People get drawn in by the envy of seeing others succeed and the pure thrill of a gambler's excitement, completely detaching their decisions from the real, underlying value of whatever they're buying. So, to demystify how this psychological virus dictates your retirement funds and property values, we are going to trace its path through 5 key areas today: the epidemic of optimism, the stock market rocket ship, the bond market puzzle, the global housing mirage, and finally, preparing for the pop. Let's start with part 1, the epidemic of optimism. Every single time the market goes on a massive run, you'll hear people claiming the exact same thing: we've entered a new era. They'll argue that the old rules of economics just don't apply anymore because of some new technology or a political shift, but Shiller's research reveals that these new era stories, they're rarely deeply held convictions. Mostly, they're just convenient justifications for herd behavior. They allow people to willfully ignore the underlying risks and justify buying in, simply because everyone else is doing it. This breaks down the exact anatomy of that psychological contagion. It's a massive social feedback loop. It always starts with the news amplifying a price increase. That sparks the word-of-mouth spread of those new era stories we just talked about. Suddenly, you hear about your neighbor getting rich, which breeds envy, and you get that gambler's thrill. But perhaps the most dangerous part of this whole loop isn't that the public firmly believes prices can never fall. It's just a collective, massive inattention to the very possibility that they could. Moving right along to part 2, the stock market rocket ship. When we look at the data spanning over a century, there is a stark contrast between corporate reality and market euphoria. If you track real corporate earnings, the actual profits companies are bringing in, they grow on a fairly steady, gradual path all the way from 1871 to 2014. But if you look at stock prices during the 2000 millennium boom, they shoot up like a rocket. They were completely, wildly detached from the underlying earnings reality. Nothing like that had ever happened in stock market history on that kind of scale. We can actually measure the extreme nature of these moments using something called the CAPE ratio. That stands for cyclically adjusted price earnings, and it compares stock prices to a 10-year earnings average to smooth out business cycles. Looking at history, it's clear these euphoric new eras are really just cyclical repeats of the exact same psychological mistakes. Whether we're talking about the 1901 20th century peak, the Roaring '20s peak right before the '29 crash, the '66 Kennedy-Johnson peak, or the massive millennium boom in 2000, it's always human exuberance pushing prices to completely unsustainable multiples. And hey, it's absolutely crucial to understand that this is not just an American disease. Leading up to 2000, real stock market valuations in places as diverse as Brazil, France, Germany, and China all roughly tripled at the exact same time. The contagion is truly a global phenomenon. Which brings us to part 3, the bond market puzzle. People often think the bond market is driven purely by mathematical foresight, but it's just as susceptible to human confusion. A lot of this stems from failing to grasp the difference between nominal and real interest rates. The nominal rate is just the stated return on a bond, but the real rate, That's what you actually earn after subtracting inflation. It sounds simple enough today, but incredibly, the concept of a real interest rate wasn't even formally introduced to the world until an economist named John Bates Clark wrote about it in 1895. And honestly, over a century later, the broader investing public still heavily confuses the two, fixating on the stated number rather than their actual purchasing power. Now, if bond investors were perfectly rational, calculating machines, as traditional economic models love to suggest, bond yields would smoothly predict future inflation to protect the investor's real returns. But that is not what happens at all. Instead, long-term interest rates almost perfectly mirror the past 10 years of inflation, rather than anticipating the future. It reveals a highly speculative and deeply reactive component to the bond market that just isn't objectively rational. This irrationality gets even crazier when you look at inflation-indexed bonds. These were specifically introduced to guarantee a real return and protect you against inflation. You'd think rational investors would flock to these, right? Yet, the public largely ignored them. Yields for these bonds in places like the UK and the US trended downward for decades, eventually crossing into completely negative territory around 2012. Think about that. People were literally locking up their money for decades to guarantee a loss of purchasing power. That is a cultural flight response, not financial logic. Next up, Part 4, the global housing mirage. Following the early 2000s stock crash, the psychological contagion didn't just disappear, it mutated. It turned into a synchronized global housing boom, from North America to Europe and Asia to South Africa. Entirely different nations with completely different local economies and unique housing policies all experienced massive, simultaneous run-ups in home prices. Now, when a boom like this happens, people love to rationalize it with glib excuses, don't they? They'll say, well, we simply ran out of land, but the data shows population growth was steady, not sudden. They'll claim lumber or steel became incredibly scarce, but construction costs were totally in line with long-term historical trends. Or they'll just blame central bank rate cuts, even though rates have been cut plenty of times in history without causing a synchronized worldwide housing boom. The data completely debunks these logical fallacies. What we were seeing was a textbook speculative epidemic, this time played out in the very homes we live in. Finally, Part 5, preparing for the pop. So why does all of this matter to you? It's highly relevant because we live in what former President George W. Bush once dubbed the ownership society. We've built an economic system where everyday citizens are essentially forced to be speculators. We have to take ownership of our futures through retirement accounts and real estate. While that can promote economic growth, it also invites massive, widespread speculation. It means that these abstract psychological concepts, these powerful feedback loops of optimism and envy, directly dictate the wealth of normal families and literally the food on our tables. Ultimately, whether we're analyzing the soaring price-to-earnings ratios of stocks, the mysterious negative yields of the bond market, or the glib justifications driving up real estate prices, the central lesson remains exactly the same. Markets are not pure, infallible calculators of fundamental value. They are dictated by what the legendary economist John Maynard Keynes called human animal spirits, our collective fears, our wildest hopes, and our inescapable irrational exuberance. Which leaves us with one final critical question you've got to ask yourself before making your next big investment or before buying into the next media headlines celebrating record highs. Are we genuinely in a new era of endless, fundamentally justified growth? Or are we, once again, just catching the next speculative epidemic? Thanks for joining this explainer, and remember to always keep questioning the market.